So welcome to Crypto Monday, March 2021. This begins our fourth year since Caitlin and I started organizing this. And we've been really appreciative of the efforts of Devin and Oleg, who joined us, a couple of years ago now, it feels like, I guess. So the four of us have been putting this together every month. We were originally encouraged to do this, Caitlin and I, by Lou Kerner, who runs Crypto Oracle and may be joining us tonight, I'm not sure. And Lou first set up Crypto Mondays in New York, probably in about 2015, 2016. It's one of the first crypto networking opportunities for people. And in that world and in our world, until a year ago, these meetings were face-to-face, over wine, beer, soft drink, and some snacks. And we're really looking forward to getting back into that environment, although when that's going to be, we're not certain. Virtual meetings have worked pretty well. I would say actually very well in the last year. And we've been very pleased with the kind of turnouts we get, and especially the kind of speakers that we've been getting, who've been brilliant. And I think we're all really interested and excited to hear Amber this evening. I'm going to turn you over to Oleg, who's going to moderate tonight. And just again, wanted to thank everybody for joining us. Oleg.
Thank you, Larry. Thanks. Hi, everyone. Great to see so many familiar faces. Absolute pleasure. And even bigger pleasure to be hosting Amber, who I actually met at a Crypto Monday meetup over a year ago. And we've been in touch since. I mean, we are extremely delighted to have Amber speak here. She started her career at Goldman Sachs in the Global Investment Research team, worked at JP Morgan, where she also helped to build the JP Morgan multi-asset franchise, and also spearheaded the systematic trading strategies team. She holds a BSc in Science and Technology, 3 master's degrees, and a PhD in molecular medicine. So she's an absolute multi-talent. And she's also the founder of AllianceBlock, which is a startup that's building a framework for the world's first globally compliant capital market to bridge centralized finance and decentralized finance. And in her free time, she's also a guest lecturer at EDHEC Business School in France. And I will hand over the word to Amber so she can give her talk for tonight.
All right. Well, thank you so much, Oleg. That was a very, very nice introduction. So I'm going to try to keep things very general because I recognize some of my colleagues or ex-colleagues in the list of attendees. But I want to start with an auspicious declaration, though some might think of it as ominous, and it is to say that the revolution is here and the revolution is here to stay, and that we're starting to see a shift in our systems from what we call social technical systems, i.e. systems that are based on social relationship, to a techno-social system that is actually driven by autonomous technical mechanism. And this is going to shift the way we view economical relation in the world, and is being driven by the fourth industrial revolution, which is basically blockchain, AI, quantum computing, and other emerging technologies. So it will be a good way to start from the start and maybe dig a little bit into the why, the where, the what of Bitcoin. So all of you, I'm sure, are familiar that Bitcoin was introduced in October 2008, and originally it was meant to be a peer-to-peer version of electronic cash to allow online payment to go through without intermediation. Now, everyone has their own opinion on who Satoshi Nakamoto is or are, but I find it quite intriguing when I read the paper that was back in 2009. And it seems to me that there were actually 2 people behind this. One was a specialist in payment system, and the second one was a specialist in peer-to-peer file sharing. So I want to take you back to the past, and this actually shows my age. I don't know if some of you remember Napster, which was a music file sharing system in the US. It was based in the US, and it was shut down by the US government. Can't remember the exact date. But that brought about the creation of the Gnutella network, or the Gnutella framework that was running on what we call the gossip protocol. And Gnutella was the first decentralized peer-to-peer file sharing system. So for those of you who are familiar with Gnutella, when you read the Bitcoin white paper, it basically gives you the framework, or it gives you a good foundation to understand Bitcoin. But now the genius thing that Satoshi and his friends have done is that they created the concept of incentivization. So the issues that we had at the time in peer-to-peer file sharing was what you had: the uploaders, and then you had the downloaders. And the uploaders were basically people like you and me who would have multiple files on their system, and that would leave your computer open at night to have downloaders come and download the files. And there was no incentivization for people like me to actually keep my laptop or my PC at the time running throughout the night. And this is why the system was not very efficient. And the creation of incentivization by creating the Bitcoin was actually a genius move that proves once again that every job needs to be paid. And this is, in my humble view, the real story behind Bitcoin, because, you know, the financial crisis, a lot of people say that it was in reaction to the global financial crisis at the time, in reaction to lax regulations vis-a-vis the banks, in reaction to the banks having incredibly large risky positions on their balance sheet. But if you look at the technical, you would know that this is a paper that at least took 1 year, one year to be built. And so what initially started as a currency is actually now not a currency anymore. One of those people who actually don't like to use the expression cryptocurrencies, because when you think of a currency, you have three tenets. You have currency needs to be a store of value, it needs to be a medium of exchange, and it needs to be a unit of account. And what Bitcoin and some other large market cap cryptocurrencies are definitely units of account, but they're really a medium of exchange. Can you really go to your supermarket and take your credit card and buy some food? Maybe in some supermarket, but it's not widely adopted yet. And even though, do you really want to go and spend your Bitcoin to buy food? No, not really. And then the last one is the store of value. So Bitcoin is definitely not a store of value. When you think about store of value for currencies, you need to look at the volatility of the currency. And when you look at the performance of Bitcoin, it is much riskier than countries that are in recessions, like countries like South Africa or countries like Mexico. And hence, it doesn't really retain anything of what a currency is supposed to be. However, the great thing about it is that, in my opinion, it is a fantastic alternative asset class. It is an alternative asset class that maybe it has high volatility, but it comes with high return, with what we call excess positive kurtosis, meaning that you have fat tails in the distribution, meaning again that the probability of having extreme value is much higher than any other asset class. And the sexiest thing I find about it is that it is non-normally distributed. So as an alternative portfolio manager, having part of your alternative allocation into Bitcoin and cryptocurrencies makes a lot of sense. So now let's go back a little bit and think about it as why is it an asset class? Because, you know, there's still a few people that don't agree that Bitcoin and cryptocurrencies constitute an asset class. Well, in our view, in our studies, we see that actually it has fulfilled most of the criteria to be defined as an asset class in terms of low correlation or no correlation to other asset classes, in terms of increased liquidity, when you think about tighter bid-ask spread percentages, close ratios, turnover ratios, and in terms of adoptions. So you can really look at crypto assets now as an alternative asset class, especially when you know that alternative asset classes like PEs, private equity, real estate, commodities, usually fulfill at least one role in a portfolio. So it's either capital growth or income generation, risk diversification, and hedging. So it is clear that Bitcoin brings a lot in terms of capital growth. And in our view, DeFi products are the next step in this, and they will be bringing a lot in terms of income generation. So let's just talk a little bit about the drivers, because I have been having a lot of questions recently about how to analyze Bitcoin, how to value Bitcoin, and what types of metric, what types of drivers are behind prices. So the first one and the simplest one is a story of supply and demand. Of course, you're all familiar that the supply is limited. There's 21 million Bitcoins to be being mined and to be mined. And the demand, as we can see, is a demand that is increasing and that will keep increasing for multiple reasons. Some people look at it as digital gold. Some people look at it for a hedge against inflation. I particularly look at it more of a hedge against systemic risk in the system, and particularly systemic risk versus the United States government. Now, we've seen a loss of faith, I would say, recently in the US government by seeing a lot of people coming in and investing in Bitcoin, which for me is actually a loss of faith. Why do we have this loss of faith in the US government? Well, I mean, we're all aware of what happened in 2008. We're all aware of the insane monetary policies and the insane fiscal policies that the world has gone through. We're all familiar with this expression, new normal. But this new normal is becoming more and more abnormal. So since 2020, the United States has increased its money supply by 25%. The Fed balance sheet has increased by 40%. So just to translate it in other words, you can say that basically the Fed has printed 40% of all dollars in existence in 2020. This is a little bit mind-blowing. So people talk about inflation and wonder how inflation has not translated into the system. Well, obviously people are sitting at home, they're not consuming, but what's happening is that you have a huge inflation in asset prices, whether it's in equities, we see it a little bit in cryptocurrencies, and we see it in different asset classes. And this basically, well, now that yields are rising up, this creates an environment that is becoming more and more risky. And despite the current euphoria that we have in markets, portfolio managers are becoming a little bit more careful about the next steps. So in my view, maybe it's not tomorrow, maybe it's not in 1 year, maybe it's not in 5 years, but as soon as there's a loss of trust in the Fed or a loss of trust in the US government, the world is definitely going to change. And you would want to have a sort of a black swan hedge in your portfolio. You would want to have an asset class that is uncorrelated to governments, that an asset class that is not going to be, well, in some way regulated by government, and an asset class that behaves in a way that is separate from what a central bank is doing. Another driver is technical analysis. That one is a little bit funny. So I see crypto asset as one of the very few asset classes where technical analysis becomes a self-fulfilling prophecy. And it's probably due that at the origin, you had a lot of smaller investors coming in, and a a lot of them were familiar with FX investment and were using these technical analysis to, analyze volumes, analyze price, etc., etc. But now it is definitely a self-fulfilling prophecy, and anyone who trades Bitcoin actually knows technical analysis much better, much better than a trader in an investment bank. Trust me. Now, the sexiest part of all of this for me is what I call the indicators that are specific to blockchain and specific to miners. So these indicators are not usually well known, or people are not really familiar with them, especially those that just start trading Bitcoin. So you have something like NVT, which is network value to transaction, which is roughly an adjusted market cap divided by transaction value, which you could look at as a sort of a price to sales ratio in equities. You have what we call median transaction value. You have a network volatility. You have network velocity. Network velocity is quite a nice one because it tells you how long or how many times does one Bitcoin change hands or change wallets within a year. And so, for example, today I was looking at the numbers, and it shows that we're roughly in the 400% range. And the 400% range usually tells you that people are actually holding on to their Bitcoin. Keep in mind that in 2000, I think it was in 2017, during the bull run of 2017, right before the crash, we had this velocity at 1,800%. And last one that is also interesting is net unrealized profit and losses, which is an indicator on whether the network is at profit or the network is at a loss. And usually it hovers around zero. So if it becomes negative, it means you're at a loss. If it becomes positive, it means you're at a profit. And it's a good indicator of how market is going to move. Usually when you become really negative, it means you need to re-enter, because miners are going to re-enter, and it's like a buying opportunity, and the opposite on the higher side. And actually, a last one, which we saw today. So I woke up this morning and I looked at the flow onto exchanges, and you've seen that there was a large transmission of Bitcoins onto exchanges. And usually this is a sign that there's going to be people selling, which actually happened. So now we've talked a little bit about Bitcoin. So let's focus a little bit on other cryptocurrencies. And well, the second largest by market cap is definitely Ethereum. And another interesting thing that we're seeing in the market, and I think that it's going to keep increasing, is the divergence in the drivers between Bitcoin and Ethereum. So we have the EIP, which is the Ethereum Improvement Proposal 1559. Coming out in July, which should put some deflationary pressure on the supply, and actually hopefully solve the issue of gas prices. Because as you know, gas prices in the end pushed us into wild capitalism, because in cryptocurrencies the transaction fee is not based on a percentage ratio. So it's not in basis point, it's not in percentage, but it's actually in fixed dollars. So you can imagine if you only want to transfer or only want to trade $100 and you end up paying a $20 fee, it doesn't make sense. Now, of course, the more money you get, the better it is, because if you transfer $20 million, you will still pay $20. So this divergence that we're seeing between Ethereum and Bitcoin is mainly driven by DeFi, by decentralized finance. So we've seen past 2 years, I would say, my company included, a boom in DeFi products and in DeFi protocols, which should start interesting a lot of the institutional players out there as soon as we have the infrastructure and the operational processes and the security sorry, that will allow these institutional to come. And as I said, I recognize a few names in the attendees. So just as an example, when the Fed rate is at 25 basis points, if you invest in USD stablecoins protocols, you can get somewhere between well, it depends, between 2 to 10%. So even if you add to this credit risk and security risk and whatever risk you want, it is still something that portfolio managers, especially in income space, should be looking at. But how is DeFi going to evolve to allow institutions to enter the game? Because, well, I mean, today we've seen what happened to Cream and Pancake Swap. There's been a I'm sorry about that. There's been an attack, a cyber attack. And so indeed, we have issues regarding securities, and this is why auditing is extremely important, and maintaining a tight hold on the network is extremely important. So again, what we're going to see, at least in the next 10 years, is a bifurcation in DeFi product, where you will have DeFi products that are well, fully decentralized, open source, anonymous, and then you will have these other DeFi products that are going to be maybe less decentralized, less open source, less anonymous, but it's actually a very good thing, because these are the products that are going to be able to absorb, in my view, a lot of the flows that should come from institutional investors. And from now to 25 years time, I believe that decentralized finance would have absorbed a big part of what traditional finance represents today. Good.
Cool. Thank you, Amber. That's you're finished. Yeah.
Good. I mean, I can speak more.
we love to hear you speak, so it's always good. But maybe I think we have a few questions as well that came up. Now that would be the moment where everyone claps, but of course that's the downside with Zoom. So first question was from, let me just open it up, from Patrick. And the question was, what do you think about the threat of the miners to do a 51% attack in April to stop this change to POS for Ethereum?
Not gonna happen. Not gonna happen. But you're raising a good point, which I wanted to discuss but didn't have time to discuss. And this is the different consensus mechanism. So I personally, I mean, we are still in the infancy of the business, so it's good to do trial and errors. But I personally dislike proof of work, I dislike proof of stake, and I dislike proof of authority. And what I really dislike about proof of stake is that it basically highlights one of the most aggressive form of capitalism that we have, which is money begets money. So the more tokens you have in the system, the more voting power you have. And for an industry that aims to change capitalism to the better, it is quite nonsensical. So what I prefer is basically a tripartite system that takes into account proof of work, proof of stake, and proof of authority, meaning the amount of work you put in the system, meaning the amount of capital you put in the system, and meaning the amount of knowledge or the amount of experience that you have in the system. And this tripartite model would give you like a weighted average score, which will give any actor in the ecosystem its value and the value of his vote. So Paul, maybe, yes. Is there any concern about the market manipulation? If DeFi protocols using flash loan, we have seen single actors pumping compound TVL by around 100 million DAI based on yeah, definitely. This is what I was talking about with regards to security and with regards to being maybe less decentralized in order to allow institution to come in. I don't want to talk for the others, but the way we work is we make sure that everything is audited and continuously audited to make sure that these type of mistakes don't occur. But again, it's only by making mistakes that one can learn, and I think a lot of people learn from what happened to Compound.
Hi everyone. Sorry, my computer crashed, so I had to rejoin from mobile. So I lost, of course, all the questions that I had. But one question maybe from me quickly. I'm curious to understand also how your company fits into it, because I mean, you guys obviously target kind of this CeFi and DeFi, combining traditional finance and decentralized finance. Which is something that also we believe in my company at CoinRow. But I'm curious how you intend to do that, because right now it seems there really are these silos. There are, there's the centralized exchanges and the centralized world, and there are like the DeFi world and the true believers. And where's kind of the common ground? Like what will connect that?
So we are not on one side or the other. So we work on both sides. So just to give you a few examples, we are transforming some of our products, especially the yield product, to be adapted and being adoptable by institutions. And you have a sort of a firewall where you can have a KYC, AML, and you can have more guidance and more security to make institutions comfortable to come in. That doesn't mean that we're not solid believer in DeFi. Absolutely not the case. And one of the proof is that we're launching our staking product on March 17th, which is the first leg of what we call single-sided liquidity pools, which will allow you to bypass impermanent loss. So you will have no impermanent loss anymore. You will stake just one token in the pool, and then the algorithm will just work with different other pools to basically create liquidity somewhere else, but you will be fully hedged against your impermanent loss. So, there's, as I said, there's a fork. So you have some products that are going to be less decentralized, less open source, less anonymous, and these will be targeted towards institutional investors. But then definitely you will have products that are, fully decentralized and fully open source that will be targeted towards the community. And just to add something, so we've been working with the London Stock Exchange. We've been talking with the London Stock Exchange for the past 2 years, and we signed an agreement with them to actually have the products that I've mentioned on their platform and allow their institutional investors to invest in them once the products are live. And these are conversations that we're having on I'm not going to say a daily basis, because each day resemble the past one, but I would say on a weekly basis, we're having conversation with different clients that are interested, especially, as I said, I mean, yields are so low, right? When you can get on your USD stablecoin, like when you can get 5% or 10%, it makes absolute sense for people to look at these kind of products.
Mm-hmm. Thank you. And then we have one question. Oh, sorry, 1 second. Let me just mute myself here. We have one question from David Moore. Are the traditional finance trading floors buzzing with talk of Bitcoin because it is so exciting, or is it their interest limited if they are banned from trading it by their employer?
Well, I mean, we should remember bankers are poor people, let's put it this way. I really don't agree when people try to pinpoint bankers all the time, because they are poor people, right? They follow the trends. But in defense of bank, we need to think about two things. We need to think about the technology, and then we need to think about the application of the technology, right? So when you think about electricity is the technology, the electric bulb is the application of the technology. When you think about blockchain is the technology, Bitcoin is one application of this technology. Banks have been in blockchain since 2015. So at JP Morgan, they had one of the earliest blockchain team in 2015. They've created Quorum. They've recently created the JP Morgan coin. So they know that it is coming, and they know that it is revolutionary, and they have been working on it as well. Now, with regards to the application of this technology in the form of Bitcoin or others, when you're a market maker, your goal is to have more flow. So if you open a desk where you can trade Bitcoin because there are a lot of flows, it's obvious. There's there's no other thought. It's just, this is where market is going. You have a lot of flow, you open the desk. And then what happened is that at Goldman, they closed the desk after the bear market because there was no more flow. Now their flows are coming back. They open back the desk. That's all. It's business.
Thank you. And Caitlin, sorry, do you mind to ask the next question, because I rejoined, so I have none of the questions in my chat history.
No, that's fine. There was one there's one here from Doug. That's not necessarily a question, but I thought it was interesting. It says, your proposal regarding a tripartite approach is interesting, but surely there will be considerable dispute about the proportionality of each leg of the calculation.
Yes, so this is what I call calibrocracy, and this is something that we're working on, which will come in step 2, because as you correctly highlighted, it is not an easy thing to calculate, and it's not a simple formula. And I'm speaking about a tripartite system, but within each part you have multiple variables. But please keep following, because this is something that our AI team is working very hard on, and something that we know is going to be revolutionary, not only in the terms of protocols, but also it is something that we want to use in terms of democracy as well, right? Like, in a democratic system, everyone has one vote, his vote equal one, but it shouldn't be the case, because especially when you're voting on laws. Oh, and by the way, I don't believe in parliaments anymore. I believe that we can vote on our own laws. And in this case, if you're voting, let's say, on a law regarding oil, and if you're an oil engineer or you're an oil company, your vote should weigh more than someone who's in medicine, for example. But at the same time, if you're someone who lives in the region where the oil is going to be extracted, well, you should have also a higher vote, because you are the one who's going to be affected. So there's multiple, it's like a tentacular system, and it's complicated to just explain in a few words, because as you correctly highlighted, there's a lot of variables to take into account. But it's very exciting.
Great, thank you, Amber. And then I've got one more, I think, Oleg, that you can't see, which is from Mitch. It says, DeFi is indeed extremely interesting and promising, yet at this point, the borrowing remains fully or over-collateralized. Can DeFi replace or take market share from traditional banks if they cannot lend out true credit? Is there a way to do this in a truly decentralized fashion, as in without credit scores, for example?
Yes, there is a way, of course. So people talk about NFTs mainly with regards to arts and comic books and that sort of stuff. But NFTs can have an importance in collateralization. So you can collateralize your loans using NFTs. You can collateralize real assets using NFTs. And this is definitely something that we're working on. So if you want, just go on the website or go on the Medium blog, and you will see a post with regards to collateralization. And yes, it will not be a 100% collateral. Yes.
Thank you, Amber. I think I'm back now up to speed with all the chats, so I can take back over. We have a question from Jacob. Hi, Dr. Ghaddar. Any thoughts on the NFT explosion?
Yeah, I mean, NFTs makes absolute sense. In terms of art, it makes absolute sense. In terms of anything that is digital, it makes absolute sense. And I like it quite a bit. What I really don't like is how it became like also a euphoric market. $69 million. I'm sure Leonardo da Vinci will be turning in his grave if he saw the price this piece of art went for. Now, there's one danger in NFT, which is the on-chain, off-chain. So if you have a real asset and you're translating it into an NFT, you will need to have an intermediation between the asset and between its digital version, and who is holding the asset, how is the asset secure, is the asset real, does the asset exist, etc. So it still takes us one step further from full digitization. But it is a necessary step, but it's something that we should be aware of, which is like the security and the custody of the assets, the insurance on the assets that are being used for NFTs.
Sounds like the categories as well.
Yeah, sorry. I locked him, but he's trying to open the door.
No worries, no worries, no worries. Thank you for that. And then actually the questions are coming fast now. We have one from Doug. What do you think is the future for the cryptocurrencies that are being developed by various consortia of banks such as CBDC?
Well, CBDC is, so I'll instead of answering this question directly, I will answer it indirectly. So in the Treasury report of this year, the discussion was not on crypto asset. The only discussion in terms of crypto was on stablecoins and how stablecoins are paving the way for payment systems. You need to remember that the United States is not the United Kingdom. We're very lucky in the United Kingdom to have a faster payment, meaning that we can transfer money within like 2 hours, usually directly. You transfer it and you receive it. In the US, the system is very, very fragmented, and it is very old. And therefore, the concept of CBDC is basically to allow for faster payments. That's one. Number two, it's to allow for the digitization of fiat, which it has nothing to do with, it's zero correlation with Bitcoin, with cryptocurrencies. It's completely different. It's fiat money that is just being digitized, basically. It's a great technological advancement, but in my view, there's one thing that scares me until I've seen everything in there is, can you imagine that every penny you will spend will be able to be tracked? That is a thought that I'm not very comfortable with. Now, I have not seen the latest blueprints and the latest formulation of how these CBDC are going to emerge, but I can really see government taking even more control and making sure that, you know, every dollar is, you're able to track every dollar in the ecosystem.
Mm-hmm. Thank you. And then we have a question from Lionel. What do you make of the reported crypto ban in India and the potential for bans in other jurisdictions?
Yes. So this is something I don't really want to defend, but we need to understand where these countries are coming from. We need to understand that these countries have tight regulation, tight control on their currencies, and so the rupee, the Indian rupee, is a controlled currency, and they need to maintain their, you know, fiscal policies, their monetary policy under control. And when Bitcoin and other cryptocurrencies are used to evade the rules in the system, in a way, it is normal for governments to react in such way. Do I really agree with it? Well, it goes against my beliefs, but you know, you need to understand where they're coming from. Are we going to see things like that? Well, yeah, definitely. Any country who has a tight control on its currency and is not under embargo would want to make sure that there's no capital outflows. And if you can use Bitcoin or Ethereum or other cryptocurrencies to evade capital restrictions, then yeah, we will see more and more of this, unfortunately. So a good point you highlighted is that a lot of people, a lot of us actually discuss about cryptocurrencies or crypto assets and blockchain from a high income country point of view. But there are a lot of benefits to a crypto asset and blockchain for countries that are in the developing world. But there's always a risk for their government to actually come in and tighten. Sorry, guys, and tighten the rules. What can we do against this? Well, not much, because in the end, you need a fiat gateway, right? You need a fiat gateway. So if fiat gateways are forbidden, then these countries won't be able to have access to the system. This is also, you know, as long as you don't have, and this is why I'm telling you it is not a currency, because as long as you don't have a fiat gateway, whether you have USDT or whether you have Bitcoin or whether you have Ethereum, you cannot go and spend it. If we arrive in a world where on your credit card, you can go and spend your BTC and you can go and spend USDT, this is a different conversation, but we are not in this world. And this is why I keep insisting on it being an asset class rather than a currency.
Mm-hmm.
Sorry,
Thank you.
being an alternative asset class rather than a currency.
Mm-hmm. One question from Lewis Elliott. One of the main bottlenecks to any kind of mass adoption is, of course, transactions per second and also fees. We are already struggling with this on ETH. How do you see this playing out in the future? And do you see ETH 2.0 or Polkadot playing a big part in that?
Yeah, Polkadot and Cardano are doing a great job at this. ETH is also probably going to increase speed of transaction, but this is definitely a real problem. And this is a problem that we have in Bitcoin where, well, it's on average 5 to 8, I would say. If you compare it to Visa or MasterCard, we're way, way below. And again, you know, this is not the characteristic of a currency, it's the characteristic of, you know, a supply limited asset class. And it's fine as long as it's the case, and as long as you understand what are the consequences of these low transaction speed and how they affect fees and how they affect prices. In this case, it is fine. Now, if you want to use it as a payment system, that is a different issue, and we're still far from this. But again, the people at Cardano and Polkadot are doing a good job.
Mm-hmm. Thank you. And then one question from Paul on stablecoins. What are your thoughts on the uses of Tether to avoid sanctions and layer money laundering throughout the Asian economy? Do you think it is in any way unusual that USDT does 4x its total market cap in volume every 24 hours?
That is a good question. What do I think of it? What I think of it is, well, number one, I really want to make sure that each tether that is in the system is actually backed by a real USD. And in a way, you know, the US puts embargo on countries. It is normal for countries to try to escape them. Whenever you have restrictions, there are always ways to bypass the rules. You know, at the time, or still now, people taking or hiring private jets and taking bags of cash, you know, how does any country under embargo survive, especially countries that are that have oil? What do you think they do? They just do it manually. They just exchange the oil for dollar in cash. So this is not surprising. Is this something good? Is this something bad? I am not a politician, so I will not answer this question.
Mm-hmm. Fair, very fair enough. And then one question from Magnus Jones. What are your thoughts on initial DEX offerings?
Well, it is a good thing, definitely. It has facilitated. So the issue with the big exchanges, what happened is the demand became so high, and there's a lot of, you know, there's a lot of hidden costs. There's a lot of like networking going on. It is not like a really transparent process, to be honest with you. And this is something, very good point again. This is something that shows how young the industry is. So the crypto industry feels and smells and look like finance in the 80s, where it's all about relationships, where it's all about who you know, and it's all about how much you're paying to receive more. Good example are all of the private sales. How do you enter into private sales where you enter at like, I don't know, 80%, 90% discount sometime? You need to know someone who knows someone, or you need to be in these like special Telegram chat. From a regulatory point of view, in equity markets or in any other regulated asset class, you cannot do that. It's just, you cannot do that. You need this transparency. So we talk a lot about transparency with blockchain, but in the end, the industry is so young and it's going through, unfortunately, a lot of the bad errors, a lot of the errors that the financial industry went through in the 80s. For example, marketing, you know, you have people who are paid to actually talk about projects. Who would do that? Who is FCA authorized would do that, you know? So yeah, it is an industry that is young. It needs regulation, but this is one of the aspects that I like the less. And having DEXs out there actually allows, it gave a little bit more of a breath to a lot of the projects. And this is why we've seen like so many projects coming through. It doesn't mean it is without risk. It is very risky because anyone can now do an can list on a decentralized exchange and can list with names that are similar to other to real projects. So there's a real danger in there.
Thanks. Actually, one follow-up question from me. Obviously, in this current bull market, we see really the proliferation of governance tokens. It's basically governance tokens have become the utility tokens of 2017. In a way, but then on the plus side, obviously it's governance that in at least some cases actually controls, you know, treasuries and cash flows. So arguably there might be a little bit more behind it. But what's like your thoughts about this? Is it all going to completely collapse once the bull market is over, or do you think it's a bit more sustainable compared to 2017?
Well, I mean, it is more sustainable for the simple reason that the terms of entering into a governance token are very different from the terms of entering into a utility token. And so you cannot dump your token anytime you want, right? But it's not something that I particularly like between you and me, between all of you and me, because again, like I don't like the process. I don't like this, you know, sort of the private sales that are involved in there. I don't like the lack of transparency. It's a good step, but you know, it can be better, and it should be better because we should learn from the mistakes that we've done in finance.
Thank you. And then one question from Mitch: if the USA, Europe, China were to move to ban crypto trading, would this effectively end the crypto revolution? And alternatively, do you see the central bank interest in CBDCs as a way of governments competing to retain monetary/payments control?
So I'll answer the second one first. Not really. I mean, governments always had, not governments, but it is not really about control. It's about facilitation, and it's about decreasing costs. It's about increasing efficiency. This is what governments are thinking about when they're looking at CBDC. There's no competition with crypto, no competition. The only competition, maybe it would be against the stable coins, maybe. But you know, this is not real crypto in the end, right? Now, with regards to what was the other one you asked, were to move to ban crypto trading?
Yeah, exactly.
Well, the issue will be, you know what, you cannot. There are always ways around it. If crypto trading is banned, which I don't think it will be. I mean, in the US, we have Gessler, who's at the SEC, who is a big fan of blockchain, and who is, in my view, going to issue the first authorization for a US ETF during his tenure. And he's a very great guy because he talks a lot about regulation, and he talks a lot about what I hope is the correct type of regulation that we need in the industry for the industry to survive, because you know it cannot survive the way it is. It needs to have rules, and it needs to have tenants to make sure that everyone is protected, to make sure that there's security, that there's safety, etc., etc. So I don't think the US are going to ban it. Can China ban it? Yeah, they could, but you know, Chinese are very smart. So if China ban it, I'm sure they will use some VPN and like just trade it out of Hong Kong, right? But of course, it will be a negative overall on the sector, but it's not going to stop. You know, it's not going to stop anything. The only danger is once you don't have any fiat gateway. That would be the danger, and I am sure the whole world is not going to ban crypto. So you will always be able to have a gateway somewhere.
Thank you, Amber. And then one question from Erdem. What do you think about GBTC discount? Why is it happening?
I don't really have an opinion on this. I didn't really look at it, but I'll check it out.
Yeah, and I think, guys, do we have any more questions? This was the last question here. Any more questions? Otherwise, I might have one last question from my side. Are there any projects that you're particularly excited about that are coming, that are either already launched or kind of early days? Anything that you are like just really tracking and you think it could make a big difference?
Well, my project.
And apart from your project?
I like injective protocol, Chainlink, Ocean protocol, basically all of our partners.
That's a good answer, very diplomatic. And actually we have one question from Patrick that just came in. You mentioned Polkadot. What do you think about Matic and
Very
Solana?
good question. I was speaking with a friend of mine who actually bought it early on, and I completely missed on it because I did not have the time to read about it. So Patrick, if you have some short summary, more than happy for you to tell us.
Patrick, if you want to just unmute yourself and speak. Where is he? Do we have, oh yeah, wait, let me unmute Patrick. Actually, I think Devon, you would have to unmute him. I'm not a moderator here.
Sure thing, I can request.
Oh, he says, sorry, noisy place. All right. We will, maybe he doesn't want to leak the alpha. There was also from Jacob a question on Solana in the same light. What do you think of Solana?
I haven't read on it, but I know that they're working on transaction scalability, transaction speed and scalability. So I think it's in the same vein. But I would be interested in knowing a little bit more about their consensus mechanism, which I'm not familiar with.
Mm-hmm. Yeah, I might be able to say a bit more about that soon, because actually we're talking also with them about building on Solana blockchain. So we met also the founder Anatoly before. It's quite interesting project actually. Also David Moore asking, why is there no GBP stablecoin?
Well, it's a good question. I think everyone is trading in dollars. I mean, the euro stablecoin came in quite late. And I personally don't even use it. So the main currency of trading is USD, but yeah, no idea why no one has thought of making one.
Yeah, and yeah, I noticed that also, but I guess we're just all very USD focused. There's actually a bunch of stable coins coming up now that are not tracking the USD. They're trying to track like back of different cryptocurrencies, for example. So it's quite interesting. People are starting to look at detaching from USD a bit as well. Yeah, so I don't think we have any more questions. Now is the last chance. Any questions? Amber, any last comments? Anything you want to share with the community?
What do I want to share with the community? Yes, join our Telegram announcement group. If you're interested in single-sided liquidity pools with no impermanent loss, this should be coming in the next few weeks. So stay tuned.
Could you post the link in the chat, and then people, I'm sure, can.
Yes. 1 second.
Okay, I've got it somewhere here myself.
Yeah, I'm sorry. As I'm moving out, I don't have Wi-Fi anymore, so I'm using my phone to connect. Makes it a little bit slow.
Is it the one I just posted?
Yes, that's the one. Yes.
Yeah, I took it from your website. Okay, cool. So this is the one. We're gonna all join and start providing liquidity. Cool. Caitlin, Larry, Devon, any last words? Otherwise, I think we can.
Thank you, Amber. Thanks everyone who joined us.
Yes, absolutely. We appreciate everybody coming.
We have a Telegram group as well, which I've popped in the chat if you want to join us there. But yeah, thank you, Amber. That was fantastic.
Well, thank you. Thank you for the invitation. Hopefully next time we will see one another face to face. That would be good.
Fingers crossed.
Absolutely.
Thank you so much, everyone. Thanks, Amber. And
thank you.
See you all next month.
Thanks everyone for joining.
Bye-bye.
Thank you. Bye-bye. See you.